They always ask me how to get rich. Almost no one asks how to avoid losing money. That's the difference between the smart and the merely enthusiastic. The enthusiastic want shortcuts. The intelligent want to survive. I've been in this business long enough to know that you don't have to be smart to make money. You just have to avoid being stupid. And, unfortunately, stupidity never goes out of style. People forget that losing money is much easier than making it. When I first stepped onto Wall Street, I thought my mind would protect me. Equations, predictions, probabilities, they're all my companions. But the market doesn't care how smart you are. It doesn't even know you exist. Its arrogance punishes insight faster than it rewards it. Back then, I believed loss was a temporary inconvenience, something to be compensated for. I didn't realize it was the greatest teacher I could ever encounter. You don't learn from profit. You learn from pain, if you have the courage to face it. The first real loss I ever experienced was small, almost insignificant by today's standards. But the embarrassment, unforgettable. I had analyzed every number, every chart. My thesis was perfect, until the world reminded me that perfection was nothing but fiction. I remember walking home that evening in the Manhattan fog. The streetlights were like dull gold coins in the mist. With every step, the voice of a man who thought he understood value but was paying the price for his ignorance echoed. That night, I started writing. Not about stocks, but about myself. I wrote the same sentence over and over. What's the difference between risk and stupidity? It took me years to find the answer. Most investors confuse risk with volatility. They believe that if prices are moving up and down, the risk must be high. But volatility is just movement. It's not dangerous. The real risk is not knowing what you have, needing the market to confirm your position to believe you're right. Initially, I was obsessed with being right. I would argue, prove, and defend my positions. But the market doesn't reward stubbornness. It rewards humility. Over time, I realized that preserving capital isn't about guessing, but about preparation. A good investor doesn't chase returns, they build a shield. And that shield doesn't start with numbers, it starts with temperament. To never lose money, you must first shed your illusions about control, certainty, and the myth that only intelligence can save you. I often tell my students, if you don't know who you are, the market is an expensive place to learn. When prices fall, most people panic because they weren't investors at all. They were speculators in disguise. They mistook movement for finesse, luck for skill. And when the tide went out, they realized they were swimming naked. Avoiding loss doesn't start with charts, but with character. Not with foresight, but with patience. The principle on which I ultimately based my philosophy was simple but difficult to live by. Margin of safety. It sounds strange, but it's deeply human. It's the acceptance that you can be wrong, that mistakes are possible, and that uncertainty is infinite. A margin of safety isn't just a number, it's a measurable humility. Every time I invested, I asked myself, what if I'm wrong? If the answer frightened me, I didn't invest. This isn't pessimism, it's realism. Markets reward those who respect risk, not those who reject it. In the 1930s, while most people sought recovery, I sought resilience and strength. The world was rebuilding, optimism was dizzying, but undisciplined optimism is a disease. I witnessed people lose fortunes because they confused hope with strategy. I remember a colleague who was a wonderful man. I can't miss this rally, he'd say. He was right. He didn't. And he didn't survive. He bought every dip, convinced that recovery was just around the corner. When that corner finally arrived, there was nothing left to recover from. He wasn't a fool in the classic sense. He was human. And humanity, when combined with greed, becomes a dangerous combination. The secret to never losing money isn't being invincible, but being prepared to be wrong and still survive. This is what most investors misunderstand. They seek certainty when they should be seeking resilience. A stock can drop 50% and still be a good investment if you bought it. But if you bought it wrong, even a 10% drop feels like the end of the world. Margin of safety is your emotional shield. It allows you to act rationally when others are losing their minds. It's easy to preach patience when prices are rising. But when the market turns against you, your philosophy is tested. I've seen investors cling to failing companies because they can't bear to admit they were wrong. That's not investing. It's denial disguised as loyalty. The market doesn't reward loyalty. It rewards logic. To never lose money, you must learn the art of surrender, to reason, not to the crowd. Strange, isn't it? The very thing that makes people successful in life, confidence, can be their downfall in investing. Confidence blinds you to uncertainty. It whispers, "You're smarter than the market." Real? Never. Even I, after decades of study, analysis, and carefulness, have made mistakes that cost me dearly. But each one taught me a lesson. A loss avoided is a gain multiplied. Every dollar you protect is a dollar that could rise the next day. That's why I always tell my students, you don't have to earn money the hard way. You just have to avoid losing it the easy way. When you focus on not losing, you automatically think longer. You stop chasing the noise. You stop reacting. You start planning. You begin to understand that markets aren't battles of the mind, but tests of endurance. It's not the smartest who win, but the calmest. Patience, not foresight. Discipline, not desire. If you can learn to sit still while running through the crowd, you've won half the game. Because long-term survival is success. People think discipline means controlling money, but it never is. It means controlling yourself. Money is just a mirror. It reflects your habits, your fears, your impulses. If you can't master them, no amount of analysis will save you. When I was young, I thought control meant action, buying, selling, reacting. But the longer I stayed in this business, the more I realized the greatest control comes from inaction. Doing nothing, when every instinct is screaming for you to do something, is the hardest behavior you can endure. I once sat across from a young investor, full of caffeine and confidence. He showed me charts, lines, and arrows. "This stock is about to explode," he said, as if certainty were a guarantee. I asked him a simple question. "What will you do if it doesn't?" He paused. Then he smiled nervously. "It has to be," he said. That word, "it has to be," is the anthem of the ruined. Nothing in the market has to be. Not even logic. Especially logic. He didn't last long. Not because he wasn't smart, but because he couldn't handle being wrong. He wasn't investing. He was looking for confirmation. This is the disease of modern speculation. People don't buy stocks. They buy confirmation of their beliefs. When I wrote The Intelligent Investor, I wasn't writing a textbook. I was writing a survival guide. Every page was a scar. You teach wisdom in practice, not theory. It's paid for by mistakes. And I paid, not just with money, but with sleep, pride, and time. Every mistake taught me one truth. The most dangerous time in investing is when you feel invincible. Because when you feel secure, you stop questioning. When you stop questioning, you start making assumptions. And assumptions are silent killers in the markets. To never lose money, you must be skeptical, not from the market, but from yourself. You should constantly ask yourself, what am I missing? What if I'm wrong? What's the cost of being wrong? This isn't paranoia, it's prudence. In the modern financial world, caution is out of fashion. Everyone wants to be bold, visionary, and groundbreaking. But the wealthiest investors I've met weren't bold, they were cautious. Being cautious doesn't mean being timid. It means being deliberate. It means knowing exactly what you're risking and why. There's a story I rarely tell about a company called Consolidated Gas. It was a time when energy stocks were a new fad. Everyone was flocking to them. It was the safest bet on the street. The numbers were promising, the dividends were attractive. Analysts couldn't stop praising them. Even my closest colleagues urged me to get in before it's too late. This phrase has always amused me. Too late for what? I took a closer look. The profits were real, but the debt was a dormant volcano. The company's stability depended entirely on interest rates remaining low. A single interest rate hike would shake the entire balance sheet. So I gave up. People called me paranoid, old-fashioned. Months later, interest rates rose. The company collapsed within a year. The same colleagues called me lucky. But it wasn't luck. It was patience. It was doubt. It was a refusal to believe in perfection. Luck, you see, is what happens when preparation meets opportunity. And loss occurs when ego meets illusion. To avoid loss, you shouldn't rely on excitement. Excitement is market fodder. When everyone is enthusiastic, danger hides under the applause. I often say, be afraid when others are greedy, and be greedy when others are fearful. Warren later made this quote famous, but the spirit behind it isn't about dissent. It's about balance. The crowd isn't always wrong, but it's often blind. And blindness spreads faster than reason. If you never want to lose money, you must train yourself to see what others ignore. Silence, patience, boredom. Great fortunes are made in calm, not chaos. I learned this by watching markets quietly collapse. Not a crash, just a fading. The kind of decline that doesn't make headlines, but quietly erodes portfolios for months. Most investors can withstand panic. Few can withstand monotony. When prices plateau, they start itching to take action. Something must be done, they think. That's when the seeds of loss are sown. Boredom. The most difficult skill in investing is to do nothing. It's also the most profitable. There was a period in the late 1940s when my portfolio barely moved for a year. No big gains, no big losses. Just stability. Students asked me, "Aren't you nervous?" I smiled. Nervy? No, I'm content. Contentment is a forgotten virtue in the financial world. Everyone wants more. But more has no finish line. The pursuit of more is what destroys people. You see, wealth is built by subtraction, not addition. Subtract the mistakes. Subtract the ego. Subtract the rush. What remains after subtraction is survival. Survival buys you time. And time is the most powerful compounding force in the universe. An investor who survives long enough always wins. Not because they're smarter, but because they survived when others weren't. That's the essence of never losing money, longevity. You can't build compound returns on a bankrupt foundation. A 50% loss requires a 100% return to recover. Most investors never do the math. That's why I always say, the first rule of investing is not to lose. The second rule is to remember the first. You don't need to double your money every year. Just hold on to it. Because when you lose your principal, you lose your most valuable resource, your recovery time. That's why my entire philosophy is based on a single idea. Protection first, profit second. People think protection limits growth, but it doesn't. It enables growth. Because protection gives you the emotional stability to stay invested, weather the storms, and think clearly. If you know your downsides are protected, you can face any upside calmly. But when you're at risk, every price movement feels like a personal judgment. It's not investing. It's torture. I once wrote, investing is most commercial when it's wisest. My point was simple. Treat every dollar as if it were a business you owned. Would you buy a business without understanding its costs, risks, and weaknesses? Would you sell it just because your neighbors suddenly increased the value of theirs? So why do investors do this every day with stocks? Because they don't view stocks as businesses. They view them as lottery tickets. And lotteries, by their very nature, create losers. If you truly never want to lose money, you must make peace with boredom. You must be comfortable with being unimpressive. You never shine in bull markets. You never get praise for your composure. But when things turn around, you're still here. And survival, a quiet, uncelebrated, steady survival, is the most underestimated victory. I used to believe the market was a puzzle to be solved. Now I know it's more like a mirror, reflecting human nature in real time. Every spark of greed, every ripple of fear, every justification we concoct to justify our impulses, it's all there, naked and relentless. And the harshest truth of all, human nature doesn't evolve as quickly as technology. The tools change, the minds that wield them don't. That's why new eras in the financial world always end the same way. Old emotions win again. I remember walking down Wall Street in 1928. Everyone was smiling. Newspapers called it the new economic era. Brokers were hailed as geniuses. Taxi drivers were offering stock tips. Office workers were trading on margin. I wasn't smiling. I'd seen this movie before under different names. A rising market isn't a sign of prosperity. It's a test of sobriety. You see, prosperity has a strange side effect. It makes people forget the principles that created it. Caution disappears. Doubt seems passé. Success begins to seem like fate. And in the markets, fate is always followed by punishment. One evening that year, I attended a dinner with a group of brokers. The conversation was loud, confident, and unstoppable. One man stood up with a glass and said, "Gentlemen, the stock market has reached a permanent high." Applause erupted from the table. Later that night, a young colleague asked, "Why didn't you share a toast with them?" I replied, "Because permanence is an illusion that destroys every bull market." He didn't understand it then. He would understand a year later. The 1929 crisis didn't just destroy wealth, it destroyed illusions. And illusions, once shattered, reveal truths you can't ignore. First truth, the crowd is not your friend. Second, markets punish arrogance faster than ignorance. After the crash, the same brokers who once preached certainty disappeared. Confidence turned to silence. That's when I began teaching my students a new idea. The real enemy of investors isn't risk, it's reaction. You see, markets don't beat investors. Investors beat themselves through impatience and overconfidence. I once told a class, an investor's greatest enemy is probably himself. And it wasn't just an idea. I'd seen it. Men who were rational in business became emotional in the markets. They hated to see others get rich faster. When prices were high, they bought because they felt secure, and when prices were low, they sold because they were afraid. In other words, they were buying comfort and selling opportunity. This cycle repeats itself every decade, every generation, with new names, dot-coms, housing, cryptocurrency, artificial intelligence, but the psychology never changes. Different stock market symbols, same human mindsets. So, avoiding loss isn't about avoiding risk, it's about avoiding self-deception. The delusion that you're smarter than the market. The delusion that this time is different. The delusion that someone else's success means you're falling behind. Comparison is a slow poison. It turns caution into envy. I've seen countless people lose fortunes not because of a lack of knowledge, but because they can't stand seeing someone else get rich. They've forgotten that the market isn't a competition. It's a reflection. You don't win by outperforming others. You win by outlasting them. One afternoon during my recovery, a young investor approached me with a trembling excitement. He had a can't-miss idea. A company poised to revolutionize manufacturing. He spoke rapidly, the words falling over each other like coins from a jar. When he finished, I asked, "What's your margin of safety?" He hesitated. It'll grow rapidly, he said. That's not safety, I told him. That's hope. He frowned. But the upside? Besides, if the downside is killing you, the upside doesn't matter, I interrupted. This is the essence of my philosophy. Every investment must have a margin of safety, not a guarantee, a buffer, an acceptance that you might be wrong. Because you will be wrong. And if you can't afford to be wrong, you won't last long enough to be right. The market doesn't care how hard you work, how pure your intentions are, or how deserving you think you are of success. It rewards humility and punishes arrogance. Every great investor learns this eventually, often painfully. Warren learned early. Charlie too. They listened not only to my words, but also to my mistakes. They understood that the goal isn't to appear smart, but to survive. That's why I smile when people call them geniuses. They're not geniuses. They're survivors. And surviving in this business is the rarest kind of genius. To never lose money, you must base your entire philosophy on persistence, not prediction. Prediction is arrogance disguised as analysis. Being persistent is understanding that your capital must withstand all weather conditions. You can't predict the next storm, but you can build a house that won't collapse when it does. This house is built on discipline, patience, and skepticism, the three pillars of smart investing. Discipline keeps you from chasing the noise. Patience prevents you from reacting to every emotional impulse. Skepticism prevents you from believing the crowd that says, "This time is different." When you combine these three, you rarely get rich overnight. But you never wake up poor either. The truth most people refuse to accept is that not losing money is more powerful than winning quickly. A 10% compound return safely beats a 50% gamble that fails once. But it's not exciting, and people crave excitement. They forget that the road to wealth isn't paved with brilliance, but with boredom, restriction, and repetition. Real investing isn't fun. It's about endurance. I often tell people, the point of investing isn't to prove you right, but to avoid being proven wrong. The market will always tempt you with shortcuts. It whispers promises of quick riches, secret systems, and exclusive information. But every shortcut leads to the same dead end, complacency. And complacency is a harbinger of loss. There's a simple rule I follow in my life. If an idea seems too simple, it's probably risky. Risk is a drug. It dulls your focus. It makes you forget to check the fundamentals while admiring the view. The moment you feel invincible is the moment you're in the greatest danger. The market waits for that moment, and it always gets its due. I always say, it's not the losses that destroy you, but your inability to sit still after them. When you lose money, you don't just lose the numbers on a page. You lose the illusion of control. And most people can't stand it. They rush to fix it, to chase it, to reclaim their pride. That's when the real damage begins. Markets don't corrupt investors. Ego corrupts them. The ego refuses to accept randomness. It whispers, "You were right, the market was wrong." And in defending this illusion, people cling even more tightly to failure. They spend good money after bad, chasing losses like gamblers chasing honor. If you want to see the anatomy of a financial collapse, watch someone who can't admit their mistakes. I witnessed it firsthand after the crash. Investors who once walked proudly on Wall Street now walked with their heads bowed, clutching newspapers like lifelines. A silent, desperate question hung in their eyes. When will it return? But the market owes no one a return. It doesn't care what you need. It simply reflects your actions. That's when I established one of my simplest and most unpopular rules. Never rely on the market to save you from your own decisions. If you're down, you need to learn why, not when it will rise. Because the market is unforgiving. It forgets. When investing, you should care deeply about the process but remain indifferent to the outcome. You should analyze with passion but make decisions with indifference. This paradox surprises many people. They think disengagement means apathy, when in fact it means control over oneself. A young student once said to me, "Mr. Graham, I want to invest with faith." I said, "Belief without humility is dangerous. The market only rewards faith when it's tied to self-doubt." He looked surprised. I explained, "Belief without humility turns into arrogance. Humility without faith turns into paralysis. Balance these, and you'll survive. To never lose money, you must first accept that you will lose, usually temporarily. The goal is to ensure that these losses are never fatal. Permanent loss is when you transform temporary pain into irreversible damage by panicking, overreacting, or abandoning your discipline. In this sense, not losing money isn't about perfection. It's about staying safe. You don't have to win every battle. You just have to stay in the fight. Years later, Warren came to me, grinning. He'd made an investment that had tripled in value. I congratulated him, but I asked, "So what did you learn from that?" He said, "My patience paid off." I nodded. "What if it hadn't?" He smiled again, this time more subtly. "Then I'd still have my capital." That was the right answer. That's when I realized he'd grasped a deeper lesson. Good investors measure success not by profit, but by resilience. Because resilience creates a compounding effect. Invisible in the short term, unstoppable in the long term. If you want to protect your capital, build systems that protect you from yourself. Establish rules that curb emotions before they arise. Determine how much risk you're willing to take before greed seizes you. Decide when to sell before fear whispers in your ear. Your process must be stronger than your emotions. Otherwise, they will destroy your process. In my later years, I realized that true wealth is measured not by return, but by restraint. Whether they admit it or not, every great investor battles the same enemy, their own reflection. They struggle with the urge to follow the crowd, the need to be right, the fear of missing out. These aren't financial problems. They're human problems disguised as financial problems. If you master yourself, you can master your money. But if you can't master yourself, your money will always master you. I used to keep a little sign on my desk. It said, "There are no new eras, only new victims." This reminded me that markets are cyclical because people are predictable. The details change, but the emotions, greed, envy, pride, fear, remain the same across the centuries. History doesn't repeat itself because of economics. It repeats itself because of psychology. So, if you want to avoid losing money, study people, not prices. Most investors focus on the wrong question. Where will the market go next? The right question, where will I go when it gets there? Because, after all, your portfolio is a reflection of your temperament. If your emotions are fickle, so will your returns. So I say, the secret to successful investing isn't genius, but character. Genius can win you applause. Character keeps you going. One afternoon, long after my retirement, a reporter asked me, "Mr. Graham, what's the most important rule in investing?" I thought for a moment and then said, "Don't lose money. And if you can't, don't lose it twice." He laughed, thinking it was a joke. It wasn't a joke, because losing money once is a lesson. Similarly, losing twice is a choice. Looking back decades later, I realized the secret isn't in formulas, ratios, or valuations. It's in temperament, the calm insistence on doing the boring thing while everyone else is chasing excitement. People think intelligence is an advantage. It's not. Temperament is. And that's the great irony of investing. The traits that protect you from loss aren't exciting enough to sell books about. Patience doesn't trend. Discipline doesn't go viral. But they quietly combine with loyalty, just like interest itself. People like to believe they're in control. They love dashboards, charts, flashing stocks, those little symbols that whisper that you're in control. But the truth is, most of the time, you don't manage the market. You manage your own anxiety about it. Every day, I watch the guys in the stock market staring at the tape as if their mere attention could manipulate the price. They believe that if they just stared long enough, hard enough, they could make the stocks rise. They were like sailors shouting at the tide. Control is a beautiful illusion. It calms you until it costs you your capital. The best investors I knew were observers, not controllers. They understood that markets move in waves, not because someone is pulling the strings, but because human emotions are moving. They knew that to surf a wave, you must first accept that you can't stop it. That's the paradox of control. The more you try to control the outcomes, the more the outcomes control you. I always say, investing isn't about prediction, it's about preparation. Prediction feeds the ego. Preparation protects survival. The difference between a speculator and an investor isn't intelligence, but patience. Speculators need to be right quickly. Investors only need to be right eventually. That's why defensive investing is so misunderstood. People think defensiveness means fear, but defensiveness means endurance. It means playing the game long enough for your advantages to multiply exponentially. The truly wealthy, those who protect their wealth, aren't always the winners. It's those who avoid large losses. I remember a friend once saying to me, "Ben, you're too cautious. You could have made twice as much." I smiled. "Or you could have lost everything twice as fast." He laughed until 1930. Then he stopped laughing. Defensive investing isn't glamorous. It doesn't make headlines or satisfy your adrenaline rush. It's quiet, unglamorous, and consistent. That's why it works. While others seek thrills, the defensive investor musters patience. It doesn't win by running, it wins by standing still. You see, the market rewards investors who embrace boredom. Because boredom is discipline disguised as calm. Excitement is the drug that causes you to trade too soon, to buy too high and sell too low. Boredom is a sign that you're doing it right, that your process is working. If you can't stand boredom, you'll never achieve success. Because true wealth is accumulated in silence, not in spectacle. I used to tell my students, if you need excitement, parachute in. Investing should feel like watching paint dry. They'd laugh, but I wasn't joking. If your portfolio bores you, it's probably healthy. If it excites you, it's probably dying. Defensive investing starts with 3 simple questions. What can I afford to lose? What am I really risking? What assumptions am I investing my life on? If you can't answer these questions calmly, you're not investing, you're gambling. True investing is more about avoiding disaster than finding opportunity. This is the part no one writes a book about, but it's the only part that matters in a lifetime. Let me tell you a story. At the height of the bull market, I saw a young analyst bragging about his 80% return in 6 months. "Mr. Graham, I feel unstoppable," he said. "You're not unstoppable. You're untested," I said. He frowned. "What do you mean?" "Wait for the bear market," I told him. "Then you'll meet yourself." And so it was. 2 years later, he modestly returned with a portfolio half his size. "Now I understand," he said. I nodded. "Good. You just paid your tuition. Now you can start learning." Every investor pays their tuition, either in time or at a loss. The wise pay in time. The foolish insist on paying in money. Patience is the cheapest teacher. When you spend years analyzing markets, reading balance sheets, and observing mass behavior, you're building an invisible shield. But when you skip this process because you want a quick profit, the market will teach you the same lesson, only through suffering. You learn either way. The real question is how expensive your education will be. Learn to value return on capital over return on capital so you never lose money. Everyone wants growth. Few respect preservation. That's why I structure my own investments like a castle: diversified, conservative, boring. But boredom is underestimated. A castle may not move quickly, but it rarely falls. A castle keeps you in the game while others are awash in euphoria and panic. People ask me, what's the hardest part about being an investor? It's not math. It's not strategy. It's waiting. The market constantly tempts you to act, to do something, just to feel in control. But control is the greatest illusion of action. If you master the art of waiting, the discipline of inaction, you can outlast almost anyone. Because most people destroy themselves not by bad decisions, but by too many. Even Buffett used to say, "I've learned that doing nothing is sometimes the smartest thing to do." And he was right. Inaction isn't laziness, it's precision. It's the ability to distinguish important noise from important signals. The market always moves faster than you can understand it. So if you chase it, you're always one step behind. Sometimes the smartest move you can make is to remain inactive long enough for stupidity to reveal itself. If you've ever watched a storm, you know this. The calmest point is the center, the eye of the storm. Investing is no different. While panic swirls around you, the disciplined investor stands still, calm, rational, and dull. And when the storm subsides, they stand still. Because the important thing isn't speed, but survival. There's a silent truth most investors never learn. Avoiding loss isn't just about the markets, it's about mindset. It's about how you view the world. You see, every dollar you protect is a story you protect, a choice you make against the tide of greed. Every foolish trade you avoid is an act of discipline, an invisible victory. But because no one sees these victories, no one celebrates them. The crowd applauds the risk takers, not the survivors. But survival, that's the true art. When I was young, I thought intelligence was the key to investing. If I analyzed better, calculated faster, read more deeply, I would win. But age teaches something arithmetic never can. The biggest losses don't come from ignorance. They come from arrogance. Markets don't punish stupidity as often as they punish pride. Even if you've been wrong for years, you can survive if you're humble. But the moment you think you're untouchable, you've already started losing. I learned this lesson the hard way. There was a time when my analytics told me everything was fine. The numbers were clean, the margins were wide, the balance sheets were healthy. But beneath the paper data, the company was rotting, slowly, silently. I didn't notice it because I trusted my model more than my gut. When the truth came out, I lost more than money. I lost my certainty. And that's when I realized that volatility isn't the enemy of wealth. Overconfidence. Volatility tests your emotions. Overconfidence blinds your logic. When you stop questioning your assumptions, the market will mercilessly do it for you. To avoid losing money, you must accept something deeply uncomfortable. You will be wrong often. And the sooner you learn to live with that, the richer you will become. People think investing is about being right. It's not. It's about surviving long enough for your good ideas to gain traction. You don't need to win all the time. You just need to avoid the mistakes that kill you. One fatal decision can destroy 10 brilliant ones. That's why my rule has always been simple. Protect the downside. The upside will take care of itself. Years later, when I looked back at my most successful students, Buffett, Schloss, Klarman, and others, I realized something interesting. They weren't after brilliance. They were after clarity. They built systems to protect themselves from their own impulses. They didn't try to predict the market. They prepared for its mistakes. And that's the essence of not losing money. It's more about forgiveness than foresight. Forgiving yourself when you miss. Forgiving the market when it misleads you. Forgiving time for its slowness. Forgiveness gives you resilience. And resilience is everything in investing. I often say, The investor's greatest enemy isn't the market, it's the mirror. Because the reflection never lies. You don't lose money when prices fall, you lose confidence. And confidence is the driving force behind every irrational action you'll regret. You panic sell because your ego can't stand being wrong. You overbuy because your greed can't stand being patient. You hold on too long because your pride can't bear to admit defeat. The market doesn't steal your wealth. You surrender it, one emotional response at a time. The secret, if it exists, is learning to embrace uncertainty. Because the market never owes you clarity. It only offers you options. When fear rises, you'll be tempted to act. But then you must remember this. Patience isn't an action, it's waiting wisely. The most profitable thing you can do in the market is to do nothing at the right moment. Every dollar you save on a foolish trade is a dollar earned through wisdom. And over time, wisdom accumulates faster than capital. Now, I know how boring this sounds. Be patient. Be rational. Avoid risk. This isn't glamorous advice, but that's precisely why it works. Everyone's looking for excitement. You'll be looking to survive. And survival quietly translates into wealth. Because while everyone else is busy making money, you'll be busy trying to keep it. And when the tide goes out, as it always does, you'll be left standing, wondering why everyone else is drowning in the waters they think they can control. Let me tell you something I've never written in a book. The greatest returns in my life didn't come from bold ideas. They came from avoiding disaster. Every dollar I foolishly refused to risk became the foundation of a fortune I could protect. Every opportunity one let pass was a lesson in patience, not regret. People call it prudence. I call it respect. Respect for uncertainty, the limits of knowledge, and the fact that markets don't reward the smartest. They reward the most disciplined. The difference between wealth and ruin is rarely intelligence. It's emotional balance. If you can control your impulses, the impulses to chase, to panic, to overreact, you'll outperform 90% of the people who can't. Because markets, like life, are designed to test your temperament more than your intelligence. And once lost, temperament takes years to rebuild. That's why I've always believed the greatest wealth is inner peace. Money without peace is debt. Success without discipline is luck about to run out. And investing without restraint is gambling elegantly. So, if you learn nothing else from me, take this. Don't focus on how to get rich. Focus on how to survive. Because a wealth that survives is a wealth that grows. The first million is important, but the second, third, and 10th millions depend on your ability to maintain the first. There are no shortcuts, just patience, discipline, and humility. These are your only real assets. And even in bear markets, they appreciate. Looking back on a lifetime of watching markets rise and fall, fortunes made and lost, I realized that the greatest investors are not those who predict the future, but those who respect it. They understood that the game isn't about being fearless. The important thing is to be prepared. The key was to stay in the game long enough for compound interest to work its quiet magic, both financially and intellectually. I'm always asked how to get rich. Almost no one ever asks how not to lose money. And maybe that's why so few people stay rich once they get rich. Because the crowd never wants safety. They want excitement. But safety, real, rational, quietly compounding safety, is the only strategy that works forever. So, remember, you don't need to be brilliant to make money. You just need to avoid being stupid. And stupidity, sadly, never goes out of style.